Hey everybody, it's Gloria Ortiz with Real People Realty, or some of you may know me as Glow, as in hashtag Go With Glow. Today's Formation Friday is going to be about programs that are out there to buy down your current interest rate, because right now they're over 6% and some buyers are a little nervous about that. But I'm here with Jeff, who is with Caliber Loans, and he's going to give us some more information on how that could be done, the difference of payment we could save if we did something like that, and just all the 411 on it. How are you?
I'm doing great. How are you?
Great. Thank you for taking the time. So tell me about these programs that are out here right now, or specifically, I don't think a lot of buyers know that they can buy down the rate, and kind of what that means for them.
Yeah, so there are multiple ways to buy down the interest rate, and the conventional way of doing it is buying down the rate with discount points. As an example, if the rate was 6.75 today, you might have the ability to buy it down to 6.25 by paying 1% of the loan amount up front and getting that lower interest rate. That's more of a permanent buy down.
Okay.
But what I'm seeing is more popular today in this market, and what's helped out a lot of buyers with rising interest rates, is what's called a temporary buy down. And this is something where you're buying down the rate by either 2 or 1% the first and second year to alleviate the stress of these interest rates in this market and make your first or second year of home ownership more affordable.
So two questions. One is, what does something like that cost?
It depends on the loan amount. So it's based on a percentage of the loan amount. And the way that the program works is there is a 2-1 buy down option and there's a 1-0 buy down option. The 2-1 means your first year, the interest rate will be bought down by 2% from the original interest rate.
So if it was 6.75 today, you're looking at 4.75.
In year number one, year number two, it goes up to 5.75. And what you're doing is you're prepaying that interest, the difference in the interest from the actual rate, to what the first year rate is and the second year rate is up front. So what a lot of my buyers have been doing is requesting a closing cost credit from the seller to help pay for some of these expenses and alleviate those higher interest rates in the first and second year.
So it would be like go to a few $1,000s, or?
As an example, if you're looking at a loan amount of $250,000 and a 2-1 buy down, you're probably looking at about $5,500 up front, but that equates to saving $300 a month your first year and $150 a month your second year.
So it seems that the savings would outweigh what you paid up front.
It's actually exactly the same, because what you're paying up front, you're just allocating that interest to an escrow account to make those payments up front. Now, if the interest rates happen to go down and you decide to refinance, you can get whatever amount you have not used refunded back to you.
Which, that's great. So it's kind of like a win-win. You don't lose by doing this, because either you get a good interest rate for the first 2 or 3 years, and then if you are able to refi because the rates just go down, that money that hasn't been used, you get it back.
Exactly.
That's
realistically,
win-win.
You're making a financial decision up front and saying, I want to ease myself into this home ownership process. And maybe it allows you to set aside some extra money to pay down debt and to prepare for that higher monthly payment. Maybe it allows you to put aside money to furnish the home. There's a lot of different things that you have to do when you purchase a home. So anything you could do to make it easier. And it's important to know that this is not an adjustable rate mortgage. Once you reach that third year, the original rate was supposed to be 6.75. It's a 30-year fixed mortgage. It'll never go above 6.75. You're basically putting a cap on the ceiling of where you can go. Instead of saying interest rates are too high to purchase in this market, this is a tool that will allow you to ease yourself into those higher rates if they don't go down. But being in this business as long as I have, I've not seen the interest rates above 7% for more than a year. So hopefully they will go down, but the reality is the real estate market and the price of real estate will not go down. You know, there's one time in history where it did, and that was 2008. So.
Right. Well, thank you so much for this information, Jeff, because again, stuff that I may know or you may know, I do these videos so that buyers and consumers will know that this is another option for them.
Yeah.
And I think this is a great option, especially if you get the money back if you don't use it, if the rates just happen to go down anyway. So this might alleviate someone's payment. It could be like you could be saving an extra $300 a month just by doing this, depending on obviously how much the house is and what the other numbers are when you put the deal together. But
Yeah, the other thing is this could be a tool for sellers to entice buyers to purchase your property. So it's not just limited to buyers, but sellers, if you're looking to set yourself apart from the competition, this is something that would help draw some eyes to your property.
It's a win-win, I think, for everybody. If you guys have any questions about this program or want more information about buying down your rate and you would like Jeff's contact information, please let me know and I can put you in direct contact with him. If you have any questions on real estate in general, reach out to me and I'm glad to help you in any way. I'll see you guys next month. Thanks.
Thank you.